Hey there, how you doing? Welcome to the channel. So this is going to be the stock update. So it's Friday, March 12th. And so here's the kind of just going over what was going on in the stock market the last couple of days. Um, so let's look at the SPY, the ETF for the spiders, S&P 500. It's, to track that. So we look at the big picture weekly chart here. So you're looking at 2 years of data. You can see that pretty much over here. I mean, today, like this market as we covered, I mean, basically this whole week was like pretty non-eventful. And I know that's kind of shocking to some of the people that are just buying and buying and buying and averaging down and down and down on stuff in high beta stuff. But it's a fairly uneventful week from that perspective. The NASDAQ as overall is doing like worse, but still it's above its long-term moving average. So the 30-week, is similar to the 200-day moving average. But you can see here that the shorter term 10-week which is the 50-day, is flattened out. So you can see that this kind of is like, well, there's something maybe has changed on the NASDAQ composite, definitely more damage done on the NASDAQ composite than on the SPY. So if we look at the SPY, you can see that both the 10-week average and they're both going up together. All right. So yeah, it just depends what you're into there. And then I think if we took the SPY over the NASDAQ to get kind of the relative performance of these two. Let's see. I think I did that wrong. Oh, it didn't do it. Okay, let's do this. Let's back up. Let's do SPY over the QQQ. Like that. Okay, it can do that. And so very interesting. So what you're seeing here is the SPY underperforming the NASDAQ, except recently it's getting a little better. I think at this point, probably we want to just put a thick line and just kind of do that. Yeah. and then even better to just remove the moving averages from these guys. So we'll do some relative stuff like that. Yeah. So what you see here is, SPY over the Qs. So you can see that, so if you're looking here, you're seeing that, hey, NASDAQ is led and outperformed the SPY. And then more recently, there's sort of a change here. And, it was interesting. I think the George Gamma channel, he had a couple days back, he had a video on this. He's really talking about interest rates and the type of stocks that benefit from interest rates rising versus those not. And I'm seeing this turn. And, so I'm seeing this right here. I'm seeing this kind of relative performance of the SPY over the NASDAQ. And the question is, and I don't know, and this is not financial advice, but the question I have and the question I'm asking is, well, am I starting to see something like that? This kind of points to that. It kind of points to, that the SPY, the spider, the more stable stocks are starting to outperform like the tech stocks. So now let's look at the 10-year yield. So I'm just going to leave it on this yard chart, this line chart here. So you can see that the yield continued to push up this week. So this is on the weekly chart. You can see that, it's getting into that range where it's, it's pushing into here where there's probably a lot of resistance there for yields to go higher, but the rates are picking up still. So that's kind of interesting. Obviously the 10-year yield, the rate going up kind of can create issues for the economy for sure. And then here we have the dollar, it's doing its stuff, maybe not big moves, but going back to the yield on the 10-year, this is really interesting. It's this, once again, yields are not really high in the scheme of things. Right. I mean, last year yields were higher than this on the 10 years. So it's really not a big deal. But the issue is how fast they rose. It sort of implies that someone's losing control of that market. So that's kind of messed up. Now, so I noticed the relative performance of the SPY doing better. So I have a position of something on what it called XLP, Consumer Staples. And this is on the weekly chart. If you notice here, this is underperformed. So if I compare, there's XLP versus the spiders overall, and we look at, and the spiders, see, the spiders had the similar behavior, but the spiders just kept ramping up to the right. They kept making progress, whereas the XLP, if you look at it on the weekly chart, you can see here that's been kind of range bound. So the whole time that the SPY was increasing it overall and making progress going up, the XLP has been kind of in a range here for the last, call it the last 6, 7, 8 months. So, but what I'm starting to see is this like improvement here. Like the XLP is really getting a bid under here, relatively speaking. And so once again, so XLP maybe compared to XLK. So XLP is the consumer staples and XLK is like the consumer tech. So these are the wider sectors in the economy. So one of the things that, kind of questioning here is like, well, what's in these, right? So these are ETFs and these are sectors. So if we go over here to, so if we go over here to like the Select Spiders page, we can see that they have these ETFs for the different sectors. So these are very wide-ranging sectors, communication services. And the two I want to look at today are XLY, consumer discretionary, versus XLP, consumer staples. And so XLP is the one I'm saying I have a position. I also have a position in the other one too, but this is going to be kind of the issue. The consumer staples are theoretically, they're supposed to be those stocks that you would buy and continue to buy their products no matter what the economy is doing. If the economy is bad, it doesn't matter. So if you look at consumer staples, you see stuff like this, Procter & Gamble. Okay, so Procter & Gamble, what? Like laundry detergent, stuff like that, consumer products, that type of thing. And an interesting thing here is, note the weight, 15%. So, when you go and you buy this thing, you got to understand if PG gets hit, it's going to have a big effect. I mean, it's very interesting. Like here you have PG, Procter & Gamble, Coca-Cola, Pepsi. So yeah, that's funny. 20% of that, call it 20% of that is made up on the soft drink makers. That's kind of, I don't know about that. And then you have your Walmart, and then you have the two cigarette companies and chocolate. So, but these are, and see, that's the thing. Like if the economy's bad, people are still going to buy soft drinks, right? Maybe they would buy less because it's not like you don't need soft drinks to survive, but it's kind of the guilty pleasure. And chocolate too is a guilty pleasure. And if you're addicted to smoking, you're going to keep smoking. And if you need to buy food, you're still going to need to buy some food. So Walmart is and Costco are one of the lower end kind of things. So you compare consumer staples to, let's compare XLY. So XLY over here. Okay, so we're looking at XLY. Now, what's XLY? Now, this is the consumer discretionary. So now, okay, so the idea here is that discretionary spending is spending that you don't have to make. So like you have to spend money to buy food, a place to live, certain basic things, but you don't need to buy money to buy a Tesla car. You don't need to, right? You can always buy a cheaper car, right? And then Amazon, this is consumer discretionary, but this one is kind of like, it is because you're going to buy more stuff from Amazon. If you're buying stuff, there's all the discretionary parts of Amazon, which is a huge part of it. But it's also got consumer staples, and this kind of changed. This is almost in the wrong sector. It should be consumer staples probably because, especially with the pandemic and all the stuff that happened there, it's like suddenly Amazon is like, oh, you're getting your basic food, basic packaged goods, everything from them. And also with the fresh and all that stuff, you're getting your groceries from them too. And then we have like our Home Depot, McDonald's. So let's see. Yeah. And this one too. Well, see, yeah, like Home Depot would be like, if you don't have the money, you're not going to go spend money at Home Depot remodeling, discretionary. You're not going to go to McDonald's as often. You're not going to buy Nikes. You're not going to go to Starbucks or Lowe's. So these are not perfect, it's sort of, and it's interesting, TJX is in there. So the difference here. So now here's the thing, this consumer discretionary, I sort of like, have some of this and was liking it, but the thing I don't like is it's like levered pretty heavily to Tesla. It's got 15% Tesla. And if you kind of look at this chart, so we're going to look at the XLY. We're going to look at the XLY versus Tesla. Let's see if we can figure this out. So I'm not really clear on that. Yeah. I don't know if they're tracking. I think that if we look here, here's your Tesla stock, and then let's just put behind here, we're going to put this, the price of the other one up there. So what did I put up there? Tesla? Oh my gosh. Okay, price, and yeah, an SPY, and we're going to put it behind price, and we're just going to do a solid line, solid thick line, update. Okay, so we have there. So now we have this the thick line is the SPY. So we see the SPY and Tesla. Okay, so they're kind of tracking with each other, but I wanted to look at, not that one, XLY. Okay, so we're looking at XLY versus it. And I mean, you can see here that XLY here, the really dark black line, I mean, it's kind of tracking pretty well. So you can kind of see the dominance of Tesla in the XLY. So that's sort of the concern with it, right? The concern with it is that, I'm getting over, the question is, do I want to buy Tesla here? That's sort of the thing. I don't really think so from my perspective. I don't really want to. Yeah, so that's one thing that you can do, that you should do, is when you go to, okay, just a minute. Why is it doing that? Stupid thing. Yes, why don't you go away? Okay, let's try that. Okay. Yeah, so this is one of the things that, you want to do. Like if you're looking at ETFs, you go to the site and they should have the information on it, and you can look up and see what's in there. And then you can try to, kind of figure out what's going on with it. So like if I'm looking at here and I'm saying I want a wide range consumer discretionary, well, you're mostly buying Amazon and Tesla. So you got to keep that in mind. Maybe you want to just buy Amazon, maybe you just want to buy Tesla. Or if you're like, I don't want Tesla, then you're getting a bunch of Tesla. So that's the only thing to keep in mind. So let's go look at some of the high beta guys. So here's our GME. This thing's amazing. I mean, I must say GME is just pushing up, and it's at it's in the 200, whatever, 50 range, and it's holding, it's in there. So I don't know, maybe I'm wrong. I just view GameStop as a pump and dump, but we definitely have a second wave going, and it's sort of, it's kind of pressing up in there over a significant amount of time. So more power to it, I guess. It's hanging in there. Then AMC, let's see, this guy here is going, this guy is kind of holding up here too, struggling to get over that, but it's kind of hanging in there. And then our Churchill, dog meat. Yeah, kind of, I'm trying to find a home at the moving average. And then let's look at our NEO. See, in the big picture of like a NEO, and I've complained about this stock being before, it's like, yeah, I mean, like if you look at it from weekly, it does kind of make sense to buy some here, right? But the problem is just, in this day-to-day stuff, it's really tough. Yeah, see, because the problem is in the short term, it's sort of deceptive. In the short term, you now kind of downtrend, and you got some benefits here. It kind of picked up, but it's just coming into the 20-day and the 50-day, so it's just very much at risk. I mean, conceptually, you could envision that going back to the weekly, that this would recover. If it's got a base and it's got to sort it out here, you've kind of, in the short term, you've broken the trend. So even though on the long term, you're sitting there and it's still good, from a long-term thing, you got a lot of damage in there because it broke through the major moving averages. So, it's usually got to consolidate. And that's sort of the thing you see down here, here it consolidates for many months and stuff like that. So I think that's it for this one. So I think the big question is, you know, what's going on with the rates? I mean, they seem to just keep pressing up. So the rates seem to be like they're going to be higher. Is the Fed deliberately letting it happen? They don't have control. They don't care. Who knows? You know, is this gonna continue to put pressure on the high beta stocks? Probably. You know, I mean, I would say that it already is putting pressure on them. Is that's what it seems to be. You know, I mean, this whole, you know, the NASDAQ got hit much worse than the SPY. So it was good that it came up, but see the kind of short-term setup is like, look, it came all the way up to the 50-day moving average and then it can't really hold it. So that is just a classic short type setup. You know, it's not a classic buy it. So I think that like in the big picture, you know, once again, watching the Kevin guy, I mean, people are just buying stuff. They're trying to catch a falling knife and then they're like excited about it. It should be really boring. Like stock trading should be really boring. It should be just something that's like, you know, you play your system and you have to play it and you shouldn't be that emotional about it. It should just be boring. If it's too exciting, then yeah, it's probably that something's going wrong. And you know, because this one as well is set up. Like, look, that day it was up, but the thing is here it couldn't break to the new high, so it lost some ground. And it might be a setup. I mean, this type of setup is good for like running maybe on Monday or Tuesday. It's possibly could, but it's got serious resistance up here at the 51, and it's serious resistance always at the declining moving averages. So you have all this resistance that's just I mean, it's kicking you in the teeth. It's telling you right here, you know. So here you came up to here, you got a lot of resistance in there. Look at all this. And then at this area here, you got resistance too. So I don't know. I think, you know, yeah, we just need to be careful. I don't know how much, I mean, I assume then, yeah, whenever these it's not a problem. I assume that whenever these stimmy checks come out, you know, that should cause a pump into the market. So maybe, you know, the people with the GME and stuff have got it right. So yeah, I think that's it for this one. So talk to you later. Bye.